Without loans, many small businesses would never get off the ground, let alone sustain their operations. Repaying those loans, however, is not always easy. When a business fails to meet its financial obligations towards a lender, it is said to be insolvent, and a lender can employ certain measures to recoup its money.
The bank does have a contractual arrangement with the company, which sets out the terms and conditions to ensure that the bank can facilitate the loan, to also give the company an opportunity to repay the loan. And it sets out what will happen if the company fails to pay the loan. The bank also requires the company to provide evidence that it can repay the loan. The bank may get collateral from the company against its assets and use that as a security. The bank will also give the company breathing room if, of course, the company negotiates it. It can restructure the loan. It can agree for the loan to be refinanced by another lender. So there are various measures that a company can take or can utilize if it can not repay the loan.
But before a bank employs any drastic measures to recover its money, there are several procedures it will follow when a business fails to repay the loan.
Well, chronologically, the bank will impose interest. And I think if you have a loan or if you have a credit card and you default, notice that you get a default notice. Interest may be charged, penalties may be charged. But if the company persists in the default, the bank will be more aggressive, so it will issue demand notices. Usually you're told, please repay the outstanding installment. If you continue now, the bank can call for the entire loan. Where a company is not responsive to the demands or does not accede to the demands, the bank will now make a report to a credit reference bureau regarding that default, and it may engage lawyers who will now pursue recovery action as against the company.
Once the bank issues the notices as required by law, it will give the business time to act on those notices. If it does not, the bank may now take drastic measures like selling the company's property, which it had put down as collateral.
The bank may sell the property, usually by public auction or private treaty. It may also appoint a receiver or administrator to manage the assets of the company. It may also possess. This means that it takes physical possession of the asset and may lease it, and maybe from the payment of rent can use that to offset the loan.
While there may be a similarity between administration and receivership, the two are fundamentally different processes with different end goals. The goal of administration is to save the company so that ultimately it can pay its creditors. The goal on receivership, on the other hand, is to dispose of the assets of the companies, which usually end up in termination of the business from the company registry.
Receivership used to be a product of our Repealed Companies Act. What used to happen is that a bank could appoint a receiver. It's entirely a creature of statute. A bank will agree with a company that upon default, it's at liberty to appoint a receiver. And this is usually where the bank's assets are not fixed or determined. So if a company is selling computers, it doesn't have all these computers at some point. Some of it has already been sold to suppliers, and some of it it may have in its possession. Where a security is over those kinds of assets, that's known as a floating charge. And that's where usually most banks appoint receivers, where their assets are the subject of a floating charge, in that it's not one fixed particular item, but covers a general number of assets, which only now can be realized once the receivership process kicks in. Most banks don't even prefer receivership. That would be arising from loans which were given before 2015.